This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 516 was produced on January 22nd, 2026. I'm Eric Townsend. Craig Tindale is a name you might not know, but his recent Substack post highlighting geostrategic risks created by offshoring the dirty business of midstream commodities production has caught the attention of both the Pentagon and the White House. Craig is also a longtime MacroVoices listener, and he'll join me as this week's feature interview guest. We'll discuss why China is holding all the cards, and how those cards were served to them, not only on a silver platter, but on a platter made from silver mined elsewhere, but refined in China. Then be sure to stay tuned for our postgame segment after the feature interview, when we'll have Patrick's Trade of the Week, plus our latest perspective on all the major markets.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, January 21st, 2026. The S&P 500 index down 74 basis points, trading at 68.75. Geopolitics creating some volatility, but the key support lines are still holding. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The US dollar index down 26 basis points, trading at 98.79. The March WTI crude oil contract down 204 basis points, trading at 60.62. Now, while the price is off of last week's levels, we are seeing key supports holding. The March RBOB gasoline up 108 basis points to 188. The February gold contract up 436 basis points to 48.37. The momentum continues to accelerate on gold. The March copper contract down 463 basis points to 577. The January uranium contract up 186 basis points, trading to 85 even. Notable breakout over the last few weeks in uranium. The U.S. 10-year Treasury yield up 11 basis points, trading at 4.25. And the key news to watch this week is the flash manufacturing and services PMIs. And next week we have the first FOMC meeting of 2026, the PPI inflation numbers, and we get into the heart of earnings season. This week's feature interview guest is Craig Tindale. Eric and Craig discuss rare earth strategic choke points, the midstream refining, and where China is dominating critical links in the supply chain. And then they dig into what it means for AI data centers, defense readiness, industrial reshoring, and more. Eric's interview with Craig Tindale is coming up as MacroVoices continues, right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Craig Tindale. Craig is a private investor, longtime MacroVoices listener, and has recently penned an article called Critical Materials, a Strategic Analysis, which has gone absolutely viral. The Financial Times reported that it has gained the very direct attention of the White House and the Pentagon. So this is really just incredibly great work that you've done, Craig. As you know, as a longtime listener, this is not the first time that our listeners have heard concerns about how China's dominance in terms of the supply chain has considerable strategic implications. But I think you've done a far better job than anyone else of just concisely writing about exactly what the issue is. So congratulations on that. Why don't we dive right in? Strategic diagnosis of what you call the end of infinite materiality. What is this article about? Why is it important?
Well, I guess it's the ultimate genesis of state capitalism versus stateless capitalism. You've got on one side a state that is intent on dominating all areas of commerce internationally, and on the other side you've got a free market philosophy that is gained by price. And so the Chinese are basically gaming the system by lowering the cost of refining and smelting, so that they gain control. If you look at 50 to 98% of the critical metals that are needed by the West to go forward with all their electrification, their data centers, their EVs, just about everything you can think of, even the nuclear build out, it requires critical metals. Without those critical metals, you can't go forward. And what the Chinese supply chain has done is grabbed it in the middle and directed it towards itself. And it's done that at multiple layers. That one layer is the smelting and refining, which I just mentioned. The other is the offtake agreements and the mine ownership, which directs towards those smelters. Another area is the ownership of the actual mines. If you look at Xinjiang and some of the Chinese state-owned mining conglomerates, they've gradually bought everything in the West, in particular gold and silver and copper and many of the others, and they're directing those outputs. Until the last few years, those outputs haven't been used by the West, they've been used by China. They now control everything that we need to control to reshore everything. And, it's Alexander Hamilton, I think, pointed out in his 1791 article, The Report of Manufacturers that went to Congress, that liberty and freedom exists, not by itself. It's contingent on having a manufacturing and a supply channel that allows it. At that stage, Hamilton was looking at the dependence on the English. I guess I put it today that we're looking not at the English, but at the Chinese, and that all his assumptions about the importance of that existing and the manufacturing existing is actually, conditions precedent for the West to be successful. And without that, we become enslaved. We're almost serfs in SERFS, in the whole global supply chain. I guess I frame it like this, that we have a financial balance sheet, and we're good at that, putting claims upon claims upon claims, but we've disconnected from the physical or the balance sheet of matter. And so these two things are separating as we speak. As they separate, the ability for us to control our destiny becomes less and less.
You write about the feedstock paradox. I love that terminology. You're describing this phenomenon where it seems like there's something about human nature that people think about the raw material as the strategic asset. President Trump has clearly become aware of the importance of rare earth elements, but he's talking about where we can mine them. And the reality of the situation is China's got, well, you've done some fantastic statistics, so I shouldn't speak for you. Give us a perspective. How much of the refining and processing that's necessary in order to get any benefit from these raw materials, how much of that does China control today? And what would it take if the United States were cut off from that Chinese supply? What would it take for the United States and the rest of the West to recover if that event were to happen?
They've got 50 to 98% control, depending on the category of the metal. 90% is things like scandium. I'll start at scandium. Scandium is used in an aluminium alloy, and that aluminium alloy is relevant to the new combat drones. An F-35 was built on the physics of G-force 9 because that's all human beings can connect with. A combat drone can do 20 to 30 Gs because there's nobody sitting in it. And the alloys required of that are a new industrial material. The whole West produces 15 tons of scandium per year at the moment, and they need hundreds, if not thousands, of tons of scandium to build these combat drones. The only source of that scandium at the moment is virtually China. And so if we want to build our combat drones and defend ourselves and not create incentives for war, that is, there's two sides of this. One side is we have to defend ourselves. I think what people miss is if we can't defend ourselves, we create an incentive for the more powerful nation, the foreign nation, to take advantage of that. And having a good defense is important to creating a world peace as anything else. But copper's the same. Copper goes into almost everything. In some of these ultra high voltage cables, per kilometre, there's about 60 tonnes of copper. I read an article yesterday. There's 2,177 tonnes of copper in Microsoft's new AI data centre in Texas. The US plan to build 13 to 15 of these. That's a lot of copper. Everything we look at, the physical intensity of copper is apparent in it. And not just the copper, it goes into everything. Siemens at the moment have a 138 billion euro back order on equipment, things like the major transformers. The major transformers are taking 4 to 5 years to be delivered, so we can build as many nuclear power stations as we want, but if you can't put the transformers in place to actually move the electricity, and if you can't put the UHVs in place, that is the ability to transmit over power lines, they're stranded assets, these nuclear power stations. That's why a lot of these new AI data centers are being sat next to nuclear power stations, because they already have the equipment in place and they don't have to wait. So you end up in a situation where they control our destiny. They're already licensing a double licensing program, and as late as a few days ago, they decided that they weren't going to supply rare earths to Japan for the defense industry. On the other side of it, Siemens, with their 138 billion euro back order, relies almost 100% on heavy rare earths from China. The order book from China is about 15%. You can really imagine China going, well, if you want your rare earths, we want our transformers first. And so they layer upon layer the ability to dominate the supply chain just by their initial influence. And this happened in history. If we go back to 1914, there was a thing called the zinc crisis. A company called Metallgesellschaft, German company, was established as the major refiner of zinc and copper and a whole bunch of the other industrial metals. They had subsidiaries in North America and they had subsidiaries in Australia, ironically called Australian Metals and American Metals. And they basically took the offtakes from those mines and sent them to Germany. In the Battle of Augurs in 1914, the French were overrun because they ran out of shells. A lot of people don't understand why the French got overrun so easily. A lot of people say, they were still, the old generals were relying on horse cavalry and things like that. The reality is they ran out of shells. And Lloyd George was made Minister for munitions in those days because the fear was that they wouldn't be able to supply themselves. So this has happened before many, many times. It's not actually a unique thing in history. It happened, you go back in the 16th century Spain. The Spanish had all of the gold from the Americas and silver as well. But they couldn't, eventually they couldn't buy anything because the Dutch were making everything and Europe was making everything, and no one would take their gold because they couldn't manufacture anything themselves. And eventually the Spanish Empire fell, even though they had a mountain of gold. So we've got rhyming right through history of this kind of thing happen. We just haven't had it happen at this scale. Now, how can we fix it? That's a complicated subject. It obviously depends on will, whether we can, I guess, optimize the political skills to do that. I think President Trump obviously sees it, and I think he's probably seen it intuitively. He's almost Hamiltonian in his regard of manufacturing and reshoring the future materials and manufacturing capacity of the United States. And he almost follows a complete Alexander Hamilton playbook. And Hamilton came up through intense conflict, and so he knew the importance. Eisenhower was similar. Everybody reads that Eisenhower speech and says, watch out for the military and industrial complex. Eisenhower was even more interesting if you read the rest of the speech. He was worried about the manufacturing complex and the ability to be self-sustaining. And that's what he warned about. We take one message It's similar to this freedom and liberty. It's an ideal, but we forgot what the foundation of that ideal was, and that's interdependence. If we're beholden to foreign powers, we risk that liberty and freedom right across the West because we become beholden to the supplier of our goods. And they can withdraw them, they can stop our reshoring, they can do all the things that they need to do.
Craig, I think that your focus on the midstream, in other words, it's not where the rare earth elements get mined from, it's who's got the ability to actually separate those rare earth elements and produce the final product that we need for all of these applications. Some numbers taken directly out of your article, and by the way, I should have mentioned at the beginning, folks, Craig's article is linked in your Research Roundup email. It's free on his Substack, and I very strongly recommend that everyone read it start to finish. It is cover to cover, just an outstanding piece of writing. But if you look at something like gallium, which is essential for certain kinds of military radar and 5G networks and semiconductors and so forth, China controls 98% of gallium production, not where it's mined, but where it gets refined and produced. Magnesium smelting, 90 to 95%. Rare earth separation, 90%. The high-tech magnet production, which is the heart of electric vehicle motors, wind turbines for wind-powered energy and so forth, and the actuators in defense mechanisms, more than 90% controlled by China. Graphite anode production for lithium-ion batteries, more than 90% controlled by China. Tungsten production, more than 83% controlled by China. And there's a long list that continues after that. Craig, what would it take if President Trump were to get together with other Western leaders and say, boy, this leaves us exposed to where if China cut us off from all this stuff, we would be completely helpless. We can't have that vulnerability. Let's reshore and rebuild all of that capacity so that we're not dependent on China for any of this stuff. How many years and how many dollars would it take to eliminate this dependency?
Short answer is trillions. I think it's variable because there's a lot of stuff on foot at the moment. They can already see this, the White House and Congress and the Department of War, as they call it now. I track a lot of companies who are receiving funds, as far back as 2 or 3 years ago to develop our capacity to refine rare earths and all these metals. If you look at a company like UCU, Unicor, I think they've received something like $100 million already to produce a rare earths capacity in Louisiana, which has gone into initial production, I think, this month or next month. You've got companies, an Australian company like IPX, Hyperion X. Now, they're producing titanium out of Virginia, and they've got a new process that they took from the University of Utah from a scientist called Zach Fang, which is a delightful name. He works in the University of Utah. He's like the Steve Jobs of materials science. He's come up with a way of making titanium powders, at 80% less cost than the current method. There's another company that comes to Metallium that is also Australian led. It takes the technology and the IP from James Tour out of Rice University, and they use a thing called flash joule heating, which heats everything up to 3,000 joules, injects some chlorine into it. You get a metals oxide out of it that then can be separated into its different streams. Not many people realize it, but the Department of Energy tender put out just before Christmas for $325 million worth of funding to take rare earths, titanium, gold and silver out of fly ash from coal-fired power plants. For every coal-fired power plant, there's billions of tons of fly ash sitting around it that were the output of burning so much coal. They all have a significant amount of minerals still in them. They just have to be extracted. There's a number of innovations that we're doing, and it's like fits the old American, Yankee know-how innovation cycle that a lot of this stuff is coming to the fore. But what it takes is lowering the cost of capital for these projects. These projects haven't, I guess, flown in the past because, we've been funding things that give quarterly results, like social media. Like a lot of the software is going to eat the world type stuff, learn the codes type stuff, where the cost of capital is not high at the start. And once you've built the software, you just have to incrementally add to it. It's not a 10-year return, and the return is fairly significant. So we haven't, we measure bread and milk as far as inflation, but we don't measure the asset market as inflation. So we measure bread and milk, but we don't measure, the price of shelter. And so when bread and milk have gone up, we've raised the cost of capital and not noticed that a lot of the industrial projects have been killed off. But as soon as, we go to 4 and 5%, the industrial projects, die on the vine and we go back to the kind of hollowed out economy that the Fed policy creates for us. And it's the Fed policy that's, at the core of the problem. The core of the problem is that industrial projects just don't get the funding that they need. Now, the other one is weaponized pricing. We've got to deal with that. Weaponized pricing is, every time at the moment, there's a great example is copper smelting in China is being done at negative cost. So if Peru and Chile ship their copper to China, they're getting paid $50 a ton to process it. Now, you imagine what that does to the copper refiners in the West. They can't compete. And it's their method of, gaining complete control. They sent us broke in the key areas that we need to evaluate. I think one example is the chairman of Palantir has put together another startup called Epirus. And Epirus basically shoots a gallium gun, at microseconds at drones, and they just fall out of the sky. It fries their internal electrics. You put these gallium guns in low Earth orbit, and, you can fry the electrics of an ICBM inside a silo. So they have very consequential, if you take it away from us, because it changes the pathway of our defense. We talk about copper. If you cannot put the copper in place, the end product, you can't build anything that we're talking about. So we need to do what we did in 1914 and what we did in different other scenarios and bring that on shore. Now, I think there is a pathway to do that. I've got another paper coming out on how to change the Fed to do that and separate the Fed's ability to price control consumer prices, but separate out the infrastructure and industrial items so that they can survive. So they're not measured as part of inflation. And, we may even have an interest-free bond or something like that type solution where we offer not an interest-free bond, a tax-free bond, where we offer pension funds an alternative to invest in, where a pension fund would flow money into an industrial project, and it wouldn't be paid by the Treasury, it would be paid by the industrial project at a tax-free rate. The industrial project owners would partner with the state, like the Chinese do, to produce the industrial output that they need to do. There's no other way of doing it. State capitalism on the Chinese side, I think, is 50 points ahead at half time and we're not playing well enough to make a comeback.
Let's talk about how the AI trend plays into this, because a lot of military experts have opined that basically the AI race between the U.S. and China for leadership on AI is akin to the U.S.-Soviet arms race, because AI has such profound implications in terms of its military applications and so forth. From reading your article, it sounds to me like, we're headed, this is 1947, we're headed into an arms race, not with the Soviets this time, but with China, and it's about AI. And the strategy is going to be that we'll buy our nuclear warheads from Moscow. I mean, What? That doesn't make sense. How much of, you got to do two things to build an AI data center. You've got to have all of the copper and all the materials that go into building that data center, and then you've got to power the data center. How much are we dependent on China? If China thought that if we ever did get into a kinetic conflict where we're actually at war with China and they decided to cut us off, how much would that impair our ability to build AI data centers?
Well, it could potentially totally impair it. You'd end up with a situation where you've got to do rationing on the Western side to make sure that they get the materials they need to build the data centers. If we start looking at AI not as a consumer device, like I guess Michael Burry sees it, and as a weapon system, which you've just outlined, then it becomes a different equation, because if you can't build these AI data centers and they are weapon systems, the arms race takes a whole different look and feel. And all of a sudden, your return on investment and the various metrics that you would put on it as a consumer item go out the window, and it becomes a must-do. So, OpenAI to me is a weapon system manufacturer of the future. It's a reconceptualization, but it essentially is. And so, a lot of this Michael Burry thing about it's a bubble, it doesn't equate properly with where it actually sits. It's making it sound like it's a new Google, where in fact, if they don't succeed, the West might not succeed either. Now, individually, they may or may not succeed, but I think the workloads that are potentially coming onto these systems are so important that we can't look at them as a consumer device. Now, if you've got transformers taking 4 or 5 years to get to you from Siemens or Hitachi, and the rare earths they're dependent on, and then you're in quite a chokehold. You need to find that stuff from somewhere else. And, I think in the article I outlined, potential areas that would probably unthinkable today, but they won't be unthinkable tomorrow. It's 20 grams of silver in a solar panel. I propose that you tear all them up if you get into real desperate circumstances, and use them for data centers and weapon systems. The same goes for gallium and all the other things. Where we have to reframe the world to some extent. The world is not how we see it or how we've seen it. The world is a different place, and we have to reframe our conceptual building blocks to look at the world this way, because a denial by China or Russia, because Russia controls some of these things as well, in particular titanium, that framing changes how we look at capitalism even. We have to adopt some type of state capitalism, and everyone will think that's nationalization. It's not nationalization. It's just an admittance that stateless capitalism that followed price to the point of efficiency so far that we're letting our foreign powers supply the things that are crucial to our ongoing perseverance as the West. It's that important. And the density of copper is significant. The density of silver is significant as well.
Now, you wrote this article, Craig, from the perspective of geostrategy and basically trying to get policymakers' attention to recognize how vulnerable we've made ourselves to being cut off by Chinese dominance of supply chains. But you actually got to this through your own research, not trying to research geopolitics, but research investments. So let's talk about where the trades are and where some of the opportunities are. I hate to take such a grim topic and try to make a buck out of it, but that's what we do here on MacroVoices sometimes.
Well, that's what I do too.
So let's talk about that. I want to start with silver, which you mentioned a couple of times. Most analysis that I've read recently about silver says, okay, look, what's going on here is silver is basically gold on steroids. We got central banks buying up a lot of gold because they're concerned about U.S. policy. That's just causing a bubble in silver that's about to blow off. There's really nothing substantial behind it. I think you've got a very different perspective from reading the article. Tell us about silver's strategic importance. How does it play into the rest of everything that we're talking about? And Is this a bubble that's over in silver, or is it just getting started?
Well, let's just do some numbers. We've been 5,000 ton of silver short for the last 4 years. I think overall it's 24,000 tons since 2020. When we're in deficit, we have to drag it out of vaults or people's cutlery drawers in order to provide it. Silver is actually central to the whole electrification, the AI. There's 20 to 40 grams of silver in a major missile. There's 8 tons of silver in a data center. There's almost, in the robotics world, if Elon's going to build his robotics armies, there's a good percentage of silver in each robot. So it becomes a substantial input. Now, 70% of our silver comes as an offtake from copper, zinc, and lead refining, but there's 60% happening in China. Now, we're already in deficit. Let's take that into account, even with the Chinese output. Now, just before Christmas, they put some licensing in that basically said that all silver would be licensed to the end supplier. I think there's 43 different Chinese companies that can output silver. Now, what if they decided to cut all that off from us, from the West? All of a sudden a 5,000 ton a year deficit turns into maybe 10,000 ton a year deficit or more. Now, that all has to come out of our cutlery drawers. I saw one analyst say that there's 200,000 ton inside people's cutlery drawer. I doubt that, because I actually don't think anyone knows how much is in the cutlery drawers and the jewelry drawers. But we would have to drag it out of the vaults, and that's going to send silver obviously skyrocketing, because the net cost of silver in some of these products is marginal anyway. There's a lot of silver in an EV, but if silver doubled, it's only going to add 1% or so to the cost of the EV. And, then we've got to prioritize what silver goes into what. If we look at AI as weapon systems rather than consumer items, they would get priority over an EV. I'll give you another thinking model. And this is triggered by what happened to BHP recently. BHP were told that they were going to take offshore CNY as payment for iron ore, and BHP refused for a month, and then they decided that they would accept the offshore CNY. They were the last holdout of all the iron ore producers. What if China said to us, you can have these rare earth minerals, but we're going to require offshore CNY to pay for them? That would introduce a really weird dynamic, because all of a sudden you've got to have industrial companies in the West trying to reshore, the AI companies building the data centers, the defense companies trying to source CNY in order to pay for these things. I've noticed there's a number of gold producers being acquired by, if you look at the quantum of that, it's getting quite significant. What if they go for gold as money and they back the CNY with gold, and they require all of the rare earths and critical metals to be purchased under offshore CNY? They could still run their internal renminbi as a currency that was fiat, and then they run the outside currency as a reserve currency, so to speak. All of a sudden, the tables change. That doesn't mean that USD would crash or Euro would crash or anything like that, because they're still required to service debt. But it would change the whole dynamics of the currency market and still put them in a place, because you even go down to the machinery level. Linus Metals put out a note a few months ago basically saying, well, it's all well and good for us to start building these refining points in Texas, but we need the Chinese machinery to do that, because we're not making in the West the machinery to refine these metals. We're beholden to them for even the machinery. So we've got to learn how to do that. So that puts a lot of gap. That puts a lot of, I guess, risk in the West climbing back into a situation where they enjoyed for the last 4 decades, and that is dominance over, hegemony over the East.
As you look at this picture overall, where do you think the most trading opportunities are? We talked about silver briefly, but what else is going to get scarce? As much as the solution to this problem would be for governments to make big investments in reshoring, you've also said in the article that you don't think that reshoring will be profitable for a lot of American companies in the short term. So it's not the actual reshoring that you want to invest in. You probably want to invest in scarcity. First of all, would you agree with that? And if so, what other things besides silver that, silver's already seen a huge move? What hasn't moved yet? Where's the ripe trading opportunity?
I think the ripe trading opportunities are the ones where our own form of state capitalism are starting to show their face. I mentioned a few of them before, where the Department of War and the Department of Energy are starting to finance some of these companies, and I think they give us the trails to follow about the companies that will flourish in this new era. The new scandium plays, the new gallium plays. There's some winners being picked, and they're being subsidised with state capital from the West. And that's happening right across Canada, and it's happening in Australia as well. And they're the sense to follow, to good returns. Some of these companies that I'm sitting on at the moment have already had 400, 500, up to 1,000% near-term increases in price as far as stocks. MTM, for instance, I think I bought at 8 cents, and it's near $1 at the moment. I wouldn't be surprised that goes to $50 at some stage. Now, that's crazy, I know, but they're the kind of returns I think you'll get from this circular economy. IPX that I mentioned, it uses some IP out of the Rice University, and what it does is it heats up fly ash and e-waste. So, all the circuit boards and that are, sitting in millions of tons in the US. And it heats them up and injects some chlorine into it and makes a metal chloride mix out of it. And then you can separate it at the chloride stage. So, I can envisage a company, I just don't mean this one. There's a dozen of these types of companies where all of a sudden we're processing the e-waste. They just made an agreement to take 2,500 tons of e-waste off Glencore. So they're fraternizing with the large industrials, and they take that e-waste, and out of a ton of e-waste, there's about 500 grams of gold. Out of a ton of e-waste, there's about 300 grams of silver. I mentioned fly ash, the same thing. Is if you heat it up, add the chlorine mix, you get this chloride that all of a sudden makes it a circular economy. We can start processing these things, and this kind of fits the mode that we've used in the past in war situations under conflict, where we've had to use our own resources. And I think ultimately it serves us because it's going to teach us to be innovative. There's another one, Hyperion X, that's going to make titanium out of Virginia. 25% of an F-35 is titanium, but they've been given $115 million out of the Department of Defense to, I guess, upscale this titanium capability so that they can produce titanium oxides. Now, this is an innovation story. We've just had the last 2 decades where we've worshipped at the altar of Zuckerberg, who I guess is, main claim to fame is hypnotizing our attention and distracting us, where we've had, real scientists developing IP that hasn't been recognized yet because they can't get it off the ground because they can't get the capital. Now, if you look at some of these plays, they're moving from pilot to commercialization, and you've obviously got that risk element there. But if they can make it through the commercialization stage, and they've virtually done that, certainly in the IPX case, these are the industrial companies of the future. These are the materials companies that have to emerge if the West is going to survive. There's no other way to do it. If you think of all the paths of doing this, it's going to be innovation, and it's going to be a reestablishment of this materials capability onshore, whether it's in Australia through the Allies or whether it's onshore in the US that has to be developed. There's no other way of doing it. And you're not going to do it the same way. That's not the American way. They will do it in a more innovative way, to stop the pollution. One of the reasons that we offshored everything is that we didn't want the pollution tax. We didn't want the pollution in our country. I think Ricky Gervais, made a great analogy about slavery being relocated to Foxconn factories with nets around them. Just because we haven't got ships and we're not bringing people over, we're still enslaving them in their own countries. Now, we can divert past that with innovation. We can, I mentioned UCU. I'll mention them via symbols because I'm an investor first. They're in Louisiana. They're developing an amazing closed loop system that doesn't have any heavy rare earth pollution with it, but throughput is lower cost than the old metric. Now, obviously, the limitations on this is, we have a limited skill base and we have a limited education base. We're telling everyone to learn to code a few years ago. And now we should be teaching them learn to go to chemistry or learn to go to engineering in order to create the industrial age 2.0. There's a number of these companies. I mentioned Linus. They're building they've got the go-ahead in Texas. They had ESG problems in Texas. You've got all these, I guess, folks who are worried about the development of some of these capabilities in US states, slowing the whole process down with agreements and bureaucracy that are now starting to be taken out of the way. So, Linus has been trying to get this thing off the ground in Texas as a rare earth refining project for a few years, and now they're going forward. And we have to get these things out of the way for them. I think it's just common sense. I would go down the rabbit hole of all of these chemical plays. There's a lot of a chemical association with critical metals plays. And, if you go down there, you'll find that, that's the future of investment. The future of investment, this era, is pivoted to a critical metal survival industrialization 2.0 that provides the feedstock and supply chain into the things that we've talked most about in the greater financial environment, investment environment. We keep talking about an AI bubble. In order to do an AI, whether it's a bubble or not, and I don't think it is, I think it's a military capability, we need to understand the conditions precedent to creating those massive AI data centers and those and all the electrification that goes with it, the energy, the gas, the nuclear needs copper. Like I said, that Microsoft one I just read a report on, 2,177 tons in one AI data centers, and there's 20 of them around the world. That's a lot of copper. I think we have to be, I guess, careful of this is not an automatic commodity play either, because China's gaming that system too. I put a note out yesterday about iron ore. The Simondou, the Guinea iron ore play for China and Rio Tinto, they've put $20 billion into an iron ore play. It's, I think, a large percentage of that goes into a railroad and, $20 billion. And it's not something that we would have risked in the West because we'd have to have a return of 20%. If you look at what China uses, they use about 1 billion ton of copper a year in all their industries. For $20 billion, they get, I think, stage 4 and 5, they get up to about 60,000 ton. When the mine's fully operational, they get to about 100,000 ton per annum. But that's at 65% mineral concentration. If you look at something like FMG, they're at 56% mineral concentration. Now, that nets out that you've got to process 8,500 tons more in ore, in dirt. You've got to get the same amount of iron ore out. So you've got this thing where if they finance it, they might lower the cost of iron ore by 10%, say $10 a ton. And that $10 a ton will give them an overall saving across their iron ore usage of $10 billion. And that $10 billion gives them an ROI of 50% of their investment. straight away inside, say, 12 to 24 months. That's a significant difference, because if their return on investment also looks at the price, it means that the iron ore, them investing in iron ore production and making these mines and making an oversupply pays them back. Their ROI is differently configured to our ROI. And so we're saying, well, the copper demand's going up, significantly, so the price will go up. That's old analysis. The new analysis says, well, the copper demand's going up. They have complete control of the supply, so our copper cost might go up. But their copper cost, if they decide to stop refining it for us, start giving it to themselves exclusively, means that they've lowered the cost of copper from all their suppliers. And that changes everything, because it changes the valuation of a company like Fortescue, FMG. It changes the valuation of BHP. It changes the valuation of Rio altogether. Because Rio, all of a sudden, even though they own 45% of the Tindale mine, they're in a cost-plus situation. They're not in an iron ore price situation.
And Craig, you've got an entire section in your article which is about disruptive technologies and where some of the investment opportunities are. So again, I very strongly encourage all of our listeners to read the article. Craig, you told me off the air you're not really promoting anything as a private investor other than reading your articles. Tell us where your Substack is, and if there's anything else you'd like to tell our listeners about what you do.
Well, my Substack is just my name, Craig Tindale. You'll find it there. Same with my C Tindale for X. And then you can find me on LinkedIn as well, because I'm publishing there as well, just my name again. All I'm asking from anybody, I've done pretty well out of investing over the last decade, and I don't really need to promote anything. What I'm really trying to promote is our own survival and awareness of what we need to do for our own survival. So it's pretty pure in that context. And I just ask you to read it thoroughly, because it's important to every one of your investment portfolios out there, and to forward it to other people, because we need to get the word out. We need to change the way we're thinking about things in the West so that we become resilient, that we survive as a culture, as a civilization. And that if we don't do that, we have a different future than I think we've grown up with.
And again, folks, the name of the article is Critical Materials, a Strategic Analysis, and you'll find a link to that article in your Research Roundup email. Patrick Ceresna and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Craig on the show. Now, listeners, you're going to find a download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Craig's picture saying, looking for the downloads.
Patrick, Craig had interesting takes on all sorts of commodities, but rare earth elements were clearly the area where he seemed to feel the best trading opportunities existed. So for this week's Trade of the Week, how about showing our listeners how to structure a bullish play on rare earth element scarcity with reasonably constrained risk parameters?
Eric, coming out of Craig Tindale's interview, the takeaway is straightforward. In rare earths, the choke point isn't mining, it's the midstream. China dominates separation and magnet production, which makes the strategic supply chain trade not a simple commodity beta play. So for this week's Trade of the Week, I want to express that theme through a basket rather than trying to pick a single winner by buying the REMX, the Rare Earth and Strategic Metals ETF. That said, timing matters. REMX is already up about 20% year to date, which makes the entry more fragile and increases the risk of a sharp short-term mean reversion. So instead of running a pure Delta 1 exposure and risking an early shakeout, I want to own the basket and dampen near-term downside volatility. The structure is straightforward. Long the REMX shares paired with a short-dated downside put. The March 20th, 2026 $84 put, roughly 10% out of the money, last traded around $3.28, or just over 3% of spot. You're paying a known premium to protect the early phase of the trade. If REMX pulls back, the put absorbs a part of the drawdown. Now, if it grinds higher, the hedge expires and the premium is simply the cost of the insurance.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's talk equities.
The perceptual pendulum seems to have swung from Trump's on a plane to Davos to announce that he's going to war with Europe, all the way back to, Trump came to Davos and told the audience that there will be no tariffs because the deal on Greenland is already done and the USA will be more than satisfied just to have military bases without taking possession of the entire island. Okay, so suddenly we're seeing a brisk rally, which I think is set to continue until, wait for it, the Trump perceptual pendulum swings back the other way. Now, I have no idea when that will be or what the catalyst will be to bring it about, but I think we've just changed directions on that pendulum, and I think it's bullish for the stock market until the pendulum goes the other way. But the big question on my mind is whether the current bullish swing is going to deliver a new all-time high print, suggesting that this market still has farther to go, or if it's going to be not quite as much as a new all-time high, in which case maybe we're seeing a topping formation here. We should know that within a week or two at the most.
Well, last week, Trump did introduce some short-term volatility with some headlines, but the market quickly absorbed the short-term pullback along its 50-day moving average and has quickly reversed back up. Now, we are seeing an S&P 500 that is generally heavy in its price action. You see the breadth of the market widening. You continue to see the equal weight S&P 500 trading right along its 52-week high like it wants to break out, and a material outperformance in the small cap sector, which continues to make fresh 52-week highs. And so we have overall a market that's being accumulated. But the same thing we've talked about for the last few weeks since the start of the year has been that the Mag 7s remain a substantial drag on this index. You can see that chart on page 4. We're breaking to lower lows as the big leadership stocks are dragging their heels. Now, we were talking about the fact that the financial stocks have just started to break down because many of them missed on their earnings, but we haven't yet seen a technical violation on the financials. They could arguably still be bought on dip and stay in primary trend. Overall, this market continues to have all of the signatures of sector rotation underway, not broad selling. Now, inevitably, markets that get heavy and tired could inevitably turn into a sell-off, very similar like Darius talked about in last week's episode. But overall, right now, the market has not broken or violated any key levels. So retesting highs is still entirely on the table. Now let's move on and talk about this dollar.
Last week I said that while the Dixie rally had been brisk, I thought it was being fueled by Trump's bold geopolitical moves and was ripe to retrace if a deal was struck and those geopolitics calmed down. Well, sure enough, as soon as Trump announced that there would be no need to tariff 8 European Union countries, all of a sudden the Dixie has retraced much of that rally. So I think we're still in a consolidation range with no clear directional trend, and I think the headlines will determine the next leg.
Well, the dollar breakdown that happened here really was a euro-driven breakdown. A lot of the other cross currencies, while they moved, weren't moving meaningfully. And we still have things like the Japanese yen continuing to break down as the JGB market continues to be under substantial stress. So while the US dollar has definitively turned a little bit lower here, there isn't a lot of clarity that somehow that the downside window has reopened and it's all just going to be US dollar downside from here. There will be looking for signs that potentially it's there. We're trading exactly at the 50-day moving average. I really consider this 98 to 99 zone on the dollar index to be a kind of a fair value zone where there's been a lot of volume that transacted there, and it's spent the last 6+ months trading in a tighter range around that level. And until the dollar shows signs of meaningfully breaking out of this trade range, then I still want to reserve a little bit of neutrality here and assume that the trade range is just prevailing here. All right, Eric, let's touch on oil here.
We're struggling with resistance at the contract 200-day moving average, which is 60.49 on March WTI. We need to see a move above 62.50 WTI in order to really confirm the bull move is on. And frankly, as the geopolitics start to calm down, the risk of a downside retrace toward the $59 and then $55 supports is increasing. So I think the headlines will drive this. Let's see which way it goes.
Well, Eric, the observations you're making on the technical levels line up the same for me. The observation I would make, though, is that oil stopped going down on bad news. And generally, even though we had a quick little pop here on the upside the other week, this entire consolidation has stayed above the 50-day moving average. So while we do have to clear a hurdle in the 200-day moving average, and we do need to see, a bull continuation pattern emerge for there to be any pivot, at this stage, at least the price action is somewhat constructive, and therefore you want to watch closely here whether this does turn into something a little bit more bullish. All right, Eric, we got to talk about gold here.
Patrick, last week I said that the fresh all-time high we just put in on the gold chart would activate measured move targets all the way up to, wow, so much higher above the market, 4,900 to 5,100. I didn't know we'd get almost all the way there in a week. Now, though, what we have is a massive $23 wide unfilled gap way down at 4,600. That's fully $250 below the current market as of recording time. That means that the bull market is still on, but we could easily see a $250+ pullback just to fill that gap in before moving higher. And when you consider that the geopolitical tempo is suddenly calming down, there's plenty of room to see that big pullback. Patrick, you're the options man, so for those of us with outright longs on here as position traders, what's the best way with a hedge or some other trade in order to lock in those gains without giving up the further upside that I'm convinced is still left in this bull market?
While there's different ways to measure out these measured moves, generally all of them overlap that big round number of 5,000, and that's what everyone's looking for here on gold. The fact this year that we've had a rally from just around 4,400 at the start of the year to a stone throw away from 5,000, we've seen a very fast advance in almost a parabolic fashion in the short term. Now, without disputing the long-term bull market of gold and the idea that debasement will inevitably draw gold to much higher levels in years to come, there's a short-term tactical high very likely to be coming in here, which will spur a consolidation. And the big question here is, should investors do something about it? And like you're suggesting, what are some of the options? Well, I recognize that this moment, at least on a short-term basis, has a poor payoff profile for new entries. So at minimum, new participants could be looking for short-term pauses for tactical entries. But investors that are long gold here have a very important decision. Obviously, selling gold has tax implications depending on where and how you hold it. And so if one wants to hold their core long-term holding and just simply put in some guardrails around their gold position from a short-term overbought condition, then accept no substitute for just putting on a collar around gold prices. As an example, on the GLD, if you were to collar up your position with a hedge 5% below the market and sell a covered call 10% higher on the strike, giving yourself still ample upside out to March, you can put on the structure for $1.50 cost per share. And so this immediately reduces delta dollar exposures and gives you some guardrails in order to lock in this beautiful advance, leave lots of room for the trade to also keep working. And so this is the one way that you can approach it. Now, if you are willing to tactically sell down your position, as an example, we've been long the GLD through leap positions, which are not these long-term equity holdings. And these, in many cases, these are up several 100%. And so these leap positions have now become very close to Delta 1. In these situations, profit taking the leaps and replacing them with bull call spreads allow you to return some convexity and asymmetry back into the trade rather than holding gold at this stage in a Delta 1 manner. All right, Eric, let's touch on uranium here.
Well, we've already been in a very brisk rally on uranium and uranium miners. Then President Trump at Davos, strongly reaffirming commitment of the U.S. government to the nuclear renaissance, really goosed the market. So this bull market is really taking off. The risk is that we've come up so far so fast that it invites a vicious pullback, which wouldn't even begin to upset the bullish trend. And frankly, chasing this uranium bull with new money way up here is kind of risky unless you're willing to ride out a pretty big pullback. So waiting for such a pullback might be the more prudent time to try to put new money to work on the long side of this market. I'm convinced, though, that it still has a long way to the run to the upside before it's over.
Well, Eric, on page 8, I have that uranium U308 futures chart. And what we can see, uranium is broken out to a 52-week new high. And so we clearly have a new trend in place. The question, of course, is will we see the equities continue to participate? They've also broken out to those 52-week highs. Definitely uranium is working right now. Nowhere near as overbought as gold and gold miners here. So it looks like there's some room to go in this uranium space. I wanted to touch on this copper chart, Eric. And so what we have seen here is that copper has started to get heavy up along the $6 level. And so we saw 2 attempts to legitimately close above it. And each time it's now given it back. At least some form of a consolidation is happening here. Obviously, the long-term fundamentals are still looking great for copper, and there's room for it to go. But after such an extended run on the upside, just, in 2 months running from $5 to $6, there's room for this to pause here and consolidate, maybe even a reversion back to its 50-day moving average for a new tactical buy on dip opportunity.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
This has been an incredibly quiet market all throughout the holiday period. And just last week, we saw the yields wake up with a spike not only above 420, but reaching all the way to 430 on the upside. Clearly, longer duration yields have all reacted negatively. And while the stock market has initially recovered the losses, we're seeing these yields getting, at least for the first few days of reaction, still staying sticky at some of these higher levels.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.